Hello investors. Last month saw some general positive returns across most developed markets. The S&P rose 4.77% and the tech-heavy Nasdaq index rose 0.8% in sterling terms. Closer to home, the FTSE 100 rose just shy of 3%. The UK bond markets and the pound recovered from their September lows as the new government set about providing stability in the UK's finances. This recovery has helped the foreign revenues of UK large-cap companies to increase in sterling terms, partially explaining the positive returns of the FTSE 100 over the recent weeks. This positive return over the month was against a backdrop of a weakening global economy, still rising inflation, and an unfortunate rise in unemployment and interest rates. More on this later. There have been several significant political and economic stories over the last month, namely the COP27 and G20 world leader gatherings. However, we feel the most prominent stories of the last 4 weeks have been a small decrease in inflation in America and the UK autumn budget. The delayed UK autumn budget seems to have achieved what the Chancellor, Jeremy Hunt, set out to do, which is to provide stability in the financial markets and set prudent expectations for the economic outlook of the UK until at least the end of 2023. The financial markets took the official announcements well, mostly because many of the policies had already filtered to the markets days beforehand. The Office of National Statistics confirmed the UK was already in a recessionary environment, with the UK GDP set to decrease between 0.5% and 1% in 2023. In its latest meeting, the US Federal Reserve reported that inflation had slowed to 7.7%, lower than the expected 8.2%. The market quickly jumped on the news, posting its best single-day return since 2020. We are very cautious of this news. We saw similar data in June this year with a bear market rally ensuing. Eventually, the reality of a weakening economy hit the S&P index and it tested a new low in September. We feel the same way now. Large US companies have started announcing staff layoffs in response to this weakening outlook. Whilst unfortunate, we view this as a necessary evil across all developed markets, including the UK, in the coming months. At this stage of the recessionary cycle, this is not uncommon and is required to get inflation under control. Some consolation is that economists predict this will be a lower total percentage than past recessions. In terms of the recent tactical changes, in October, we sold our property positions. We feel strongly on our thematic property sector positions over the longer term, particularly commercial warehousing and healthcare. However, in a rising interest rate environment, we feel the cost of borrowing may detrimentally affect the expansion in the property sector over the short term. In selling our property positions, we have further increased our cash positions, reducing volatility within our client portfolios during this uncertain time. We will continue to monitor the volatile market activity and continue to analyze entry points to reinvest cash at lower levels. Particular data points we are looking for are next quarter company earnings, unemployment levels, and economic wage growth inflation. We would expect the former two to decrease and wage growth to slow down before an eventual bottoming of the financial markets. This is certainly what our analysis of past recessions has taught us. This analysis also showed us that a recession does not necessarily need to fully play out before the financial markets bottom out. Markets are forward-looking, so we would expect global indices to fall ahead of a full recession being underway. Our current analysis and thinking is awaiting this moment, whilst also decreasing volatility by holding cash during this uncertain period. Like the Chancellor's recent statement, We are muting our capital market expectations in 2023. That is not to say there are not returns to be had, but we are realistic to say to our clients that it may not be a fundamental led recovery until the latter part of 2023. As always, we would encourage you to contact your financial advisor should you have any immediate concerns. If you have any further questions for us, we of course welcome them and ask our clients to contact us on the email on the bottom of your screen. Thank you.